He is the Senior Vice President of Philanthropic Investment Strategist for the Mid-Atlantic region for Wells Fargo. And he focuses exclusively on discretionary philanthropic investment management, including family foundations, charitable trusts, institutional endowments, and donor-advised funds. He's a subject matter expert in regards to the unique characteristics of charitable asset management, including time horizon relevance, liquidity distribution needs, prohibited holdings, excise taxes, self-dealing issues, and social impact investing. Prior to joining Wells Fargo in 2004, Mike served as an investment representative with Deutsche Bank Alex Brown and as an accounts vice president with UBS Financial Services, serving high net worth and institutional clients. He earned a BSBA degree in marketing from Appalachian State University and an MBA from Wake Forest. Go North Carolina. Mike currently serves on the advisory board to the Department of Finance, Banking, and Insurance at Appalachian State University, and he resides in Winston-Salem with his wife, Brooke, and their 4 children, Landon, Ella, Eli, and Emery. I think I got those right. I actually rehearsed those a little bit yesterday because you have the 3 E's at the end. It's a little tricky. Anyway, so Mike is going to talk to us about critical conversations to spend or not to spend. And Mike, I think we can probably stop the screen share and just have you take over. Does that sound good? Excellent. All right, Mike, thank you so much for joining us. Really happy to have you here.
Thank you. Well, it's my honor. And thank you, Antonio, my colleague who I've worked for many years, Antonio Seminario, and he's on the line here.
Oh yeah, he's on. Hi, Antonio.
So I think he's muted, but I'll wave to my colleague there.
Hi, everyone.
There he is.
There.
So the first thing I want to talk about is just setting the stage for what we can really do today as a group, and just being realistic, because all nonprofits are important, and it doesn't matter the life cycle, the range of size, structure, focus. Every nonprofit is important. Now, that doesn't mean all the characteristics and decision-making processes through crises are the same. And so there's a wide range net we're trying to cast here today. And what I'm trying to do is, what I'm going to try to do with my short amount of time, is simply lay a framework to make sure that there are mistakes to avoid. So the first is do no harm. So we'll start there. It's kind of like the Hippocratic Oath. That what we want to do is just make sure we don't step on any landmines that we've seen get institutions or organizations tripped up. If we can get there in 30 minutes, that's probably a victory. But what I will try to do is, again, build a blueprint and a framework for discussion. Several of the points I'll make today could be expanded on, and we've even discussed maybe having a series where we might come back and do some more expansion on this. So just a warning, this is broad, this is high level, and it's really, think of it like a blueprint or architectural framework for decision-making during crises. And then the other part would be to learn, when we come out of this crisis, things that we might want to do to prepare for the next crisis, because we always know they're coming. So the first thing I want to talk about is capital, what we have in terms of assets for a nonprofit. They say, if you're a hammer, everything looks like a nail. So I'm an investment person, so naturally my instincts are to work on large cap growth and value stocks and bonds and alternative investments, real estate, commodities, how much of each to own, who are the best managers, what the performance numbers look like. But that's really too myopic. And what I like to talk about here is to recognize that I've been doing this a long time. And one thing I realized one day is that the human capital, the staff, the people, the passion, the people that donate to your organization, their time, talents, and treasure, the staff that puts it all together and sets it organized and builds the organization and then delivers that service to your beneficiaries, to the people who receive the services. Those are the true and largest assets you have. So that human capital component is the root. If all that's in place and it's needed, and your structure is one that is proper to serve beneficiaries, to have an endowment or invested money, that's a fruit of all that other human capital activity. So I just want to know, almost tell you that I appreciate the perspective and understand where the value of the true value of an organization lies. If the mission is strong, the communication is good, the people are in place, typically we see the capital involved is following that. So that's just an acknowledgement of my perspective. So, but we will talk some about investment capital and how to deal with that directly. But first, we want to set the stage of where we are today. And I don't want to be patronizing, but the amazing part of this crisis is that it's touching every aspect simultaneously. I've been through crises. I started in the investment business when the tech bubble, I had about 3 months of good times before the tech bubble exploded. So I've seen that. And then I've seen the financial crisis, of course, and some different things in the investment arena, but never have we seen anything that affected so many aspects of organizations in our society than we do today. So it starts with a pandemic, but we have economic impact, of course, from the shutdown and the lockout. We have a healthcare crisis, obviously, from the impact of the pandemic itself. We've got a geopolitical crisis with a lot of nations and a lot of tensions being created because of the crisis. The investments obviously are going to experience a lot of volatility. And then we're going to have a lot of volatility in our relationships between the population, the government, decisions that are being made. So just a tremendous amount of tension out there. And every aspect is being attacked at once. One thing that's unique for nonprofits is when we go through a financial crisis, typically we have our investment committee meetings or our strategy meetings, and we look at our assets and say, yeah, the market's not doing well. And then our needs are up for our beneficiaries. How do we balance that? Well, we're having those questions and conversations today, but in addition to that, we're having even more foundational questions are being asked around, are we going to survive? You know, do we have the cash flow? Do we have the capital? Do we have the support that we need to survive? What about our staff? How do we communicate? How do we keep our revenues, our donors? Do we keep our organization sound? So what I think of it as is a decision-making matrix. It's a hierarchy of priorities that we have to set. And so what I'm trying to do is move away the noise and just get to the basics. And so I think you just start with level one. Level one, you say survival. What does it look like for our entity to be here 3 years from now? Let's say a year from now. We make some assumptions about the crisis. We're finally starting to get some data what it looks like to be shut down like this. What does that mean to our unemployment rates and all the economic factors and levers? And then we're starting to get more data about the virus. We don't have enough on either, or at least we're not feeling around in the dark. We're getting enough so that we're starting to develop some ranges of possibilities. If we stay locked down for X, it's going to kind of mean this. So as that as that resolution tightens in and we start getting more clarity there, we're beginning to be able to make some decisions about what we might do. So the mistake we're trying to avoid is being too caught up in the very short term, backing up enough to look at the construct and say, what are we going to talk about? What is the first order to talk about? And I think the first box you have to check is financial viability. And it depends on the organization. It depends on how you're funded. It depends on what your asset base is. It depends on if the needs of your constituents are increasing or stable through the crisis. So survival is the first thing. And once you've made that determination to say, you know, we feel like X, here are the things we need to do to ensure our fiscal stability. But if you're comfortable with that, maybe not comfortable, but you've made the decision of how to proceed through this crisis. You know, we may proceed boldly with a lot of faith that there'll be corrective actions later. Those are the decisions to make. Or you may proceed and have to kind of go back and somewhat retreat, regather, strengthen your balance sheet, make some critical decisions about different things you've been funding, and you may have to pull back on some of those. So that's when you're starting to talk about support. So the first one's survival, and the second one's support. So how are you going to support and continue to support? Does that look differently? So when you're moving to support, it's meaning, when I say that, I mean, do we continue the level to be able to give at the level or the methodology? Now, the dollar amounts may drop next year when you're based on the investment base and how much money is generated through endowments and things of that nature. So the support dollars may drop somewhat, but the process, I'm saying, is can we maintain what we've been doing? And if it's a percentage base, obviously you're going to deal with the adjustment down. And the third is if you can get through that to say, okay, I think we're fiscally stable. And we're comfortable enough with that, and we're comfortable enough to continue our support. But the constituency we serve is especially hit hard. Let's say, for instance, one of the clients I worked with for a number of years helps elderly people, delivers meals, and this crisis has been particularly difficult for them. Their demands obviously have gone through the roof. And so do you ask the question, can we expand support? Or in other words, what is a reasonable way to temporarily or permanently change our mission and morph our institution into something that helps more, or that more drives what we want to do? Do we change? So those are the three critical. First, put on your own mask before you help the person beside you. Second, can I help the person beside me like I've always done? And third, do I offer more help to the people beside me, or do I help someone differently? Do I help the person to my right or left now, or more, or one or the other? So that's the framework of how you want to do the hierarchy of priorities. So then you start then from there, that's your blueprint. Now, how do you do that? Well, you look at your resources and you say, what can be refocused temporarily? What we want to do is avoid making emotional short-term decisions without considering the long-term ramifications. So when you gather with your volunteers and your staff to make decisions around how we're going to run our organization, or what are we going to react in this organization, it's important to always balance that with it to say, if we're going to make a change, is that a temporary or permanent change? If it's temporary, how long do we anticipate that change being made, and what's the impact of that? If it involves a decision around resources, especially spending more than you typically have, even as a percentage, then you're going to say, can we get a partner to do some modeling, or someone partner with us, or a financial advisor, or through our practice, we do it all the time, help us model, what does this look like? How does this impact us long term if we were to ramp up or maintain last year's spending levels this year, even though the calculations may be going to tell us to spend less? What is the long-term impact of that? So those are non-emotional decisions, weighing the short-term and long-term, reassessing the mission, again, kind of regathering and getting your mask on. So those are the.
Can I ask you a quick question, Mike?
Please.
Sorry to break it. Could you give an example of a reactive or emotional short-term decision compared to what you just described? Like what could that look like?
Yeah, I have a client, and I'm going to try to be obscure enough to where they can be identified. And I have a client that when the crisis started, they were a particularly sensitive, nonprofit. Let's just say hypothetically is education. And so everything gets shut down, and there's all these decisions around tuition. Can we charge? Can we not charge? Everything is up in the air. Students on campus, off campus. I mean, every kind of difficult decision that could be made. And immediately got a call right after the market crashed, really, initially, to say, we need to raise, we need to get cash on hand to double our distribution this year. And that was the question. And I had a long conversation with them and talked about their lines of credit. We talked about other resources of capital. We talked about some alternative things that we could do instead of just selling out of the market low under a big hit, knowing that we're going to have a lot of volatility later. But if you can give me 2 or 3 months, I will sell into bear market rallies, or give me the opportunity and some flexibility to raise the cash. So what we left it with was, they don't need the money right now. They're afraid they'll need it in 3 months. So what ended up happening, they have a line of credit available. They decided not to draw it. So that's the first emergency thing that they could have done. And the second thing is to say, I'm committed to raising your capital, but give me 3 months to do it. So when we have markets recover, I've been able to sell equities into strength instead of out of weakness. Well, when in the investment world, when we define risk, it's defined a million ways. I think the right way to define it, after I've defined it wrong ways, maybe for a long time, it's the risk of a permanent loss of capital. And fortunately, that doesn't happen unless you become a forced seller. A forced seller in a down market is how you lose capital permanently. So if I can avoid that, we're going to be way ahead of the game. Another way to restate that, it sounds quite different, but it's very similar, is to say the biggest advantage an investor has is the amount of time they have to invest. So a nonprofit has the biggest advantage because many of them are in perpetuity, operate in perpetuity. We're coming alongside, and as an advisor, I'm managing a lot of large relationships. My largest is well over 500 million, but I'm just sliding along for, 10 or 20 years, and then somebody else was behind me and somebody's coming in front of me. And so you just want to steward those assets properly and make informed and non-emotional decisions to keep the eye on the prize, that the fact that you have the ability to be a long-term investor, that you can weather any storm. You've weathered them all since in this case, since the late 1930s. They've weathered all those storms, and you just say, I want to be a steady pilot at the wheel. And no decision's a bad decision. You just need to make sure that it's an informed decision. So that's an example of one thing where I was given 3 months, and we talked, and they recognized it was a little bit knee-jerk. And so in that time since then, I've raised the capital because we got a nice rally in the market. And so I'm ahead of schedule by about a month. And the capital is there. Then we had to make their distribution. And I agreed, we don't want to make their distribution. Fortunately, we had recognized our firm's position where we didn't plan for a pandemic. But what we did see was we were a very long ways into the longest bull market in the history of the stock market. The stocks weren't extremely inexpensive, but they weren't overpriced either. But that at some point that we need to start expecting some volatility. And fortunately, we came into the year with most of our nonprofits holding excess cash. Typically, we'll hold 2 to 3%. The majority were holding 6 to 7. So if you think about that, you're 3% away. Most portfolios are yielding between 2.5% to 3%. So you're 1 year of income away from having 2 years worth of distributions. So that was kind of the mindset coming in, which was a lifesaver, because had we not done that, and I have distributions coming up, let's say things fall apart in February, and I've got to make a big distribution in May, then I may not get an opportunity I might not have the opportunity to avoid selling something at a depressed price. And that, by definition, has impacted that investment account in perpetuity. Mm-hmm. I mean, it literally bends the curve, not the COVID curve, bends the principal expected value curve. And you can look out and see that for 10, 20, 30 years. And it's the position that I least want to be in. So with that said, that's the types of decisioning we want to make and be able to make the good decisions to give your partners time to do things in the best way that they can. So now there they are, sitting there with an excess amount of cash, ready for a special distribution if it's needed. We don't know if it is or not, but there it is. And so the cash is there. And it's a good decision. You can do that without destroying the growth potential of the portfolio, depending on where you pull that cash from. And so there's a lot of ways, even nuances within that. I'm not going to bore you any more in the details. And Antonio can tell you that, I'm a hammer and investments on a nail, and I can talk into the greatest boring detail for a long time about those things. So I want to jump back out of that.
Let me ask you another quick question, Mike, because I know this is probably something that's on the mind of our participants. So can you connect what you said, for example, for a nonprofit that has no investments, has no endowment fund, and is really maybe getting started, or is young and really just relies on cash flow? Could you tie what you just spoke about to maybe from a foundation perspective? So do we think that foundations are adopting a similar strategy where they are also looking at this long term, and they hopefully will continue their practice of providing funds to nonprofits? And then also from the donor advised fund perspective, is there anything that you can say about either of those two?
Sure, those structures are important, and the structure is critical. Private foundation, some donor advised funds by design have a required payout, but not all of them. But all private foundations do. Mm-hmm. And so you're looking at, when I ask somebody, and we're talking to, and a lot of people I work with have private foundations, and the question is, what does the long-term funding scheme look like? If the patriarch or matriarch are elderly and they're still steering the ship, but at some days are going to hand the reins down to the next generation, what does their estate plan look like? Mm. A foundation that has a modest amount of funding could become a very large foundation at some trigger event, or it could be great-grandfather's foundation. I'm already dealing with the great-grandchildren, and there's no anticipated large funding schemes at all. So knowing those two things are critical. Quite honestly, ones that anticipate large distributions or fundamentally changes distributions can be much more aggressive, because you can begin to look at to say, we hope grandma lives for another 15 or 20 years, but in some ways we can begin to invest our assets and take some risks, knowing that inside of 20 years that this charitable foundation will get a tremendous amount of funding. So it just allows a little more latitude, knowing that that's going to come in at some point. The second is, if you don't have investments and you're relying primarily on annual support, it's particularly difficult, especially when donor support is hard to communicate with your donors, and it's also difficult to look at how you're going to be able to assist when you're worried about that revenue in. Some people claim endowments or make organizations weak because they can drop the ball or not focus on annual giving as much. That can happen for sure. I think the balance is somewhere in between. So coming out of the crisis and when things stabilize, the conversations that will be had then, which are not to be had now, do we want to build some type of at least cash / safe investment, short-term operational reserve fund that will be stable and in case of emergency break glass? So that might be something to consider in a different, once we get through this crisis, once we have made survival and we get data and things stabilize, is to say, when you're talking to donors, you're making your ask and you say, oh, by the way, we're trying to build a $300,000 operational reserve fund. So that way, when we're in a crisis and your personal balance sheets are down or maybe depressed in themselves, that we're not coming to you asking for extra distributions. All you're doing is disconnecting that unfortunate simultaneous drop.
Yep.
So what you're trying to do is to really disrupt those time frames and get diversity in time. Not diversify investments, but you can diversify in time. So you're making the ask now during good times, and you're saying, I know you've given us X every year. If you could consider, we're trying to do this. And then what that will do is allow us, when we get into a crisis, is to either maintain or increase our support. At the same time, it will not require us to come back to you making a bigger ask during a difficult time when your assets are depressed.
Love that.
Another thing that makes donors feel good, and you'll forget, it's easy to remember how they were, it's hard to believe how easy it is to forget. So one thing that when the markets were really getting pounded and they were just dropping day by day by day, and this past week has been kind of reminiscent of that since the kind of the bounce back. But you remind donors that have a donor advised fund, or if they've given to you as a charity, when they gave last year in December, which is mostly when they give, when they did that last year, they did it before the decline and received the full benefit of that, as far as their personal benefits were received. And they said that's why it's smart to give consistently over time. And remember, you gave me $100. The markets turned that into $75, but you got the tax benefits of the 100. We're going to invest it and expect it to recover. But you disconnected the time frame beyond your own life cycle into this charity. And the charity has a perpetual life cycle. So yes, the assets may have declined because it's invested for the long term, but this charity is going to live in perpetuity. And as far as I know, I haven't met anybody that's going to do that yet. We did the frozen head, cryogenic heads. I think some people are getting their heads frozen so they can reanimate their body someday when the technology comes, but I haven't seen that happen yet. So right now, charities are our perpetuity.
Yes, they are. All right, it's 1:30. I want to be sensitive to your time. Do you have a final thought or wrap up? Something?
I do.
Great.
I do. So what you want to do is a couple of action steps and again, I hope this is a good takeaway. You want to just increase your communication with your stakeholders, your donors, your staff, and the people who are beneficiaries. The frequency of communication needs to be higher now because the effectiveness is declined. This is not as effective a format as we would if we were all sitting around a table.
Mm-hmm.
So I would say increase the efficiency and effectiveness of the frequency, of the meeting. Second, I would consider more ad hoc specialized committees of groups of smaller people, so it's easier to communicate. So you're going to communicate more frequently, obviously, but maybe with more targeted individuals for specific tasks. And then so you're developing a committee to say, hey, let's look at the long-term impact of if we increased our spending by $50,000.
Mm-hmm.
And then they could collaborate with the people they know and then report back to the larger body. So you want to consider doing that.
Mm-hmm.
So the fewer the better, and encourages dialogue and better decision making. And then you could, of course you would present that to the larger body and they can ask questions.
Mm-hmm.
Connect, find those supporters in your organization, the people that support your organization, really be very specific about targeting the ones that if you were to ask, and if they knew your situation, that they would say, I'm not going to let that happen. Mm-hmm. So if you find those people, they're hard to find. They're 1 out of 100. But whatever organization you're running, really focus in and spend a lot of time communicating with those people that would say, I'm not going to let it happen. Mm-hmm. And they may even say, I don't know how I'm going to not let it happen. I don't know what I'm going to do, but this can't happen.
Yeah.
And the idea in there is to have them turn and not only support you as they have, but to turn to their network. Mm-hmm. That's when you're not going to happen. And then last is, this is probably the most important one, and I'll close with this. I learned this the hard way through the last couple of months. In this format of communication, again, that's challenged, no face-to-face, they say up to 80% of communication is nonverbal. What you want to do is clearly define the agenda, pre-plan each meeting to stay on target so you don't get sidetracked. Mm-hmm. And then when you have a detailed and targeted agenda with the right people engaged, you have that meeting and then you clearly define the follow-up, mm-hmm. who is going to do it, and when it's going to be delivered. Mm-hmm. It's just so easy with this age of confinement to let that slip, and it's just never been more important.
I agree. There has to be some structure. Okay, fantastic. I love number 2, your ad hoc committees, because I think we all tend to shoulder this ourselves, and we think it has to fall on us, or that little disconnect between us as the leadership and then the board. And so there's a little bit of frustration, but I agree with you. I think forming those committees can be really powerful, and it doesn't have to fall on one person. And that's how you get help from the outside as well in the decision-making processes going forward. So yeah, absolutely. Fantastic. Thank you so much, Mike. So grateful for your time. I know you've got another session at 3, so best of luck with that.
Thank you.
And
it was my pleasure.
We're very grateful. Thank you. And thank you, Antonio, as well. Really.
You're welcome. Thank you, Kristen.
So feel free to hop off whenever you're ready.
Will do.
Thank you.
Enjoy your weekend.
Thank you. You too.
Bye-bye.
All right. So let's jump in to... So that was sort of our scratch the surface overview on financial outlooks. And I think, for me, one of the biggest takeaways is the short-term decision-making. I think we tend to be very instinctive and just kind of, make decisions that we think are going to stop the bleeding or stop a problem immediately. But looking at the long-term effects, like, for example, stopping a program that may need to be restarted, if you stop it altogether and shift and put your energy in something else, and then the time comes to be able to restart that, but your resources have been allocated elsewhere, then what? Are you still able to deliver on your mission? So I think there are a lot of things to think about. But anyway, so I'm hoping over the next couple of weeks we'll do a little more in depth on finances and talking a little bit about what some of the things we've touched on before, but in terms of restricted funds, unrestricted funds, a little bit about our budgets and programming and how to make those shifts. using a little bit about what we learned from Dr. No and his emergency blueprint, which was so helpful as well. So, but again, we do want your input on topics. So don't forget to let me know as we get closer to the end of our session.